Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian equities kick off the second half of 2026 after capping the strongest quarter in 17 years, led by gains in chip makers and other AI hardware-related stocks. Morningstar's Lorraine breaks down where risks are rising and where value is emerging, and whether tech valuations look stretched and volatile. India's growth outlook improves as easing Middle East tensions push oil lower, cutting inflation risks and pressure on the external balance. And Nomura's Sonal Varma will outline the path ahead for India's inflation, growth, and the Reserve Bank's policy stance. Asian stocks are fading fast from a strong open to the second half of the year. Rotation within the tech trade is the key dynamic as the tech rally matures. Korea is feeling the heat of foreign outflows while Taiwan's rally broadens. Let's go to Hong Kong and our markets reporter Anthony Stevens. And Anthony, parabolic price action in the first half. You got to wonder whether people are more cautious as we kick off the third quarter.
Yeah, people are kind of moving their focus into how does the AI trade mature over time. So we've moved on from this mass of AI models and the huge capex demands of training all these AI models to now the usage dynamic and what is the demand around using AI better. So people are building more data centers for localization. The ecosystem in China is growing, and the models in China have a completely different kind of set of requirements than some of the big frontier models in the US. And that's seeing Taiwan benefit at the expense of Korea. So Korea's had this huge memory boom off the back of HBM, but now they are investing these huge sums of money, and the market is concerned that maybe this is at the top of the cycle with supply coming on from the Chinese and pushback on memory prices from customers. So you're seeing that weakness again in Korea. You're seeing a long streak of foreign selling. We're at $95 billion on the year now in Korea, and that is suppressing both share prices and the Korean won. So that is something to watch. On the positive side, the breadth of the Taiwanese rally continues to expand out of TSMC into more niche players. There are now a lot of Taiwanese names that are posting three-digit gains on the year. So whether that continues as people continue to look for these AI inference bottlenecks of implementing AI in different countries, that is going to be the new dynamic to watch within the equity space. Lastly, in India, you continue to see the kind of downward pressure on the software space from increased usage of Chinese models that have much lower prices to help in coding and other software tasks.
Well, the other theme in the market is also the momentum in the dollar. We heard from HSBC's Paul Markle saying that that explosive dollar could be the pain trade that we should be looking out for.
And we're definitely seeing that pressure across Asia, right? Like you're seeing it ironically in kind of the strongest parts of the tech trade in Korea and in Japan, where the gains from the tech trade are very narrow, and both the BOJ and the BOK seem very hesitant to raise rates, and the market is leaning into that narrative, and the rate differential is driving the dollar versus these currencies in just one direction. So correlation between the yen and the won has picked up. They're both weakening together, and they're now both equivalently on intervention watch. We are at the same levels on the won that saw intervention, verbal intervention from the BOK, and we have been looking for intervention from the BOJ now for 2 days straight. So we'll see what the new levels both these central banks reset at. And meanwhile, countries like Indonesia and India continue to be under pressure, but it looks like those markets have fixed kind of some of the flow dynamics around repatriation or bonds and have found a little bit of a level here.
Anthony Stevens, always great to have you on the show. Bloomberg Markets reporter Anthony Stevens there for us. Our next guest expects the market outlook to be quite challenging for the next few months and thinks there remains the risk of a correction. Let's get insights from Lorraine, Director of Asia Equity Research at Morningstar. Lorraine, good to have you with us. I mean, it does seem like stocks are priced for perfection. Valuations, even though they seem pretty stretched and lofty, people are buying into that great optimism.
Yeah, I mean, there's probably been only one solid positive story, and that's been AI, and the news flow there generally continues or has been positive. We've seen a couple of hiccups recently. Microsoft has yet to announce their spending plan. I think that's coming up soon. So we've seen upticks in those sorts of spending ideas drive a lot of the chip companies. And so that's been, but the explosiveness of the returns that you saw in the second quarter, it is a bit scary in that sense because the market is extrapolating for the strong growth to continue through to 2028. And we do have our doubts there. We do expect spending to taper off.
But no sign of that so far, though, Lorraine. I mean, we've been trying to, predict a correction for some time now, but earnings momentum is there. And when you take a look at CapEx, that momentum is there as well. And people may question liquidity, but liquidity remains intact.
Yeah, so the thing is, we've got a situation where I think a lot of the CapEx spend the big jump in the CapEx spend is being seen in 2026. I'm talking growth rates here. I think it's continue to see spending go up, but at a slower pace in the next few years. So overall, through 2029, we're expecting sort of low teens CAGR for AI spend, but most of that jump will be seen this year. I think what that means when you start to see capacity come through, as you've seen the announcements from Samsung and SK Hynix recently, that's going to lead to what we think will be softer pricing, because essentially the supply is going to catch up with demand. And then you're not going to see that same sort of loftiness in growth rates on the pricing of the memory chips, for example. So that's where we start to see the market. Once the market factors that in, I think there'll be further correction. So I think the market is beginning to realize that things may not be able to be maintained, and we've seen added volatility recently.
Lorraine, if we do see a correction, what kind of correction can be expected? Is it a shallow one, a deep one?
It can be big for some stocks that have gone up, double, triple, whatever it is in the past couple of months. Unfortunately for us, it's been challenging because when I look at our tech coverage, we really have very, very few buy calls at the moment. So we would expect to see, 20-30% correction for some of the for a good percentage of the names that we cover before they come into areas that we think would be worth buying again. But having said that, I think you can still be selective. There is obviously underlying negative and positive factors for some other sectors that will play a role as well.
You talked about how the investment by Hynix and Samsung would lead to, prices easing somewhat in the coming quarters. I'm just wondering whether you also see potential for investment given the willingness to invest.
Yes. So a bit of, this industry is cyclical, right? It's always been cyclical, and there's been obviously very, very strong cycles, super cycles in the past. Ultimately, however, the supply does catch up, and the supply does take some time because, the planning takes 2 to 3 years. So what we expect is actually fairly tight supply through to 2028. And then we start to see more of that come through. So what that means is that, yes, demand may still rise, but we also, given the base that we have, we do expect the growth of the demand to sort of taper off, not the huge jump that we're seeing at the moment. And, as your colleague mentioned, it's like people will start to need monetizing the AI solution services that are being offered as well. So we may actually start to see a little bit of a tapering off of the enthusiasm in terms of growth. And I think that's where you see supply catch up.
Given the optimism that we're seeing right now and how prices reflect expectations of perfection within the AI space, can it all be killed in a way, I guess, if there are expectations of rate hikes by the Fed? Might that just kill off that momentum?
Yes, and the interest rates have done very good jobs of killing market rallies in history anyway. Yes, that could happen. We see concern that rising interest rates is going to taper off consumption even more. Could kill off a little bit of the spending, and I think that's where. If you're end consumer for, what I'm saying is that I think the demand for AI services will remain relatively strong. I think at the end of the day, however, if the consumer does say, I'm not going to buy this good or that good, I think that will flow through to some of the other segments of the industries that rely on chips. So we've seen, the negative reaction to Apple's price hike news. So we think the consumer electronics, the automobile side, if there's weakness there, I think that does create a little bit of a dampener. For the companies themselves, obviously, they need to monitor how much of the pricing factor is going to hurt them in terms of being able to sell, and that's one of the other things as well.
Isn't it true, though, that the inflation from technology has not been priced in yet by the markets?
Yes, that's correct, probably, for the most part. I think we're only beginning to see the incremental pricing come through. So it's impacting a lot of consumer electronics names. So basically, Apple's pushing through higher prices. Nintendo, for example, has got to absorb some of the higher costs. Consumer electronic companies can only absorb things up to a certain degree. And I think they do have to pass through the higher prices at the end of the day. And that's going to dampen demand. So they may not buy. Obviously, they're not going to produce as much out of concern for their outlook as well.
Lorraine, earlier you talked about how you don't have too many buy calls. What are you doing then?
Well, we are. There's still good quality companies that we like. So if people want to be in this space, technology space, oddly enough, TSMC is a little bit of a laggard here. So over the long term, we still like TSMC. We still like some of the semiconductor equipment companies like Advantis. We're actually seeing better visibility for their order book going forward. Sino-American Silicon is also another bit of a laggard on the chip side of the equation. The other stories are a little bit more challenging within the tech space. Yeah. Sorry, go ahead.
No, I'm just wondering if you're looking to rotate. What do you rotate into? I mean, people have talked about healthcare being quite a bright spot for investors.
Yes, I would agree. I mean, healthcare underperformed. It actually was one, when I look at the Asian sectors, it was probably the only sector that fell during the past quarter. And I think it's ripe for some re-rating upward. I mean, there's some quality names there. Some of the names we like include the biotechs in China like B1, Innovent. We think that they have a solid portfolio of drugs coming up, and pretty decent growth rates as well. So they are two attractive healthcare companies that we're looking at.
And Lorraine, if you take China as a whole, it's still looking attractive right now, no? I mean, given where valuations are, given expectations that the macro environment is likely to get better.
Yes, so China is probably much cheaper at the moment. I mean, it's really underperformed. The consumption side is weak, but I think that reflects a reduction in the subsidies in the consumer electronics and the EV side of things. But where we're seeing a bit more strength is on the services side. So we do think, and we do expect a second half economic performance to be a little bit stronger as fiscal spending comes through. So overall, slightly better data in China for the second half should lift sentiment there. The banks there did fairly well in the first half of the year or second quarter. We actually like some of the names there because we do think that the squeeze on margins should actually bottom this year. So we're looking at a better, healthier environment for for Chinese banks in 2027 onwards. On the consumer or the beneficiaries of AI being overlooked at the moment, we think Tencent is in that category. The cost savings there, obviously, they're spending at the moment as well, and they're and so that's one element to look to. Perhaps the market is a bit concerned with. We think that overall, the ability that they have with their ecosystem will allow them to basically be more efficient as well.
Lorraine, thank you so much for your insights. Lorraine Tan, Director of Asia Equity Research at Morningstar. Still ahead on Insight, Anthropic says the U.S. has lifted foreign access restrictions on its Fable 5 AI model. More on the thaw in relations between the startup and the Trump administration. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. President Xi Jinping is speaking at the Great Hall of the People, marking 105 years of the Communist Party. Some lines coming from that speech. He says that China sees opportunities and risks in development, and that China will resolutely battle against corruption and push for military modernization. And Xi Jinping also vowing to fight against Taiwan independence. And another line coming across is that he says China will solve the Taiwan problem is a Communist Party responsibility, that the Taiwan issue is a Communist Party responsibility. Again, Xi Jinping speaking at the Great Hall of the People, marking 105 years of the Communist Party. Now, staying with China, Anthropic says the U.S. government has removed foreign access restrictions on its Fable 5 AI model after the startup resolved the Trump administration's safety concerns. For more, let's bring in Bloomberg's Min Lo. Min, tell us more about the backdrop that led to this decision.
Yes, it has been a couple of weeks since the Commerce Department told Anthropic that it will need to seek U.S. approval before allowing foreign access to two of its most powerful AI models. That's the Mythos 5 and the Fable 5. We're hearing now that the government has lifted that foreign access restrictions on Fable 5, which is a less powerful version of the Mythos. A few days ago, we reported that Anthropic had made some adjustments to address the national security concerns, and that led the U.S. government to lift some selected restrictions on Mythos, which is the more powerful version. And so that is now available to selected vetted companies such as cyber defenders or critical infrastructure providers. But the Fable 5, as I mentioned, is supposed to be more public facing and for more widespread use. So that is now approved for foreign access, and it's certainly a big win for Anthropic after all that lobbying, and possibly going to be a boost for its valuation just ahead of its anticipated IPO.
And Min, Anthropic also just launched a new software for research.
That's right. This is the Cloud Science software. It's targeted at scientists and meant to automate research and automate some of these multi-step tasks that scientists have to do, such as having to query multiple different sources of information for answers. It combines a number of tools that are commonly used by scientists and also gives access to some 60 scientific databases. And this tool will be used to help with AI drug discovery as well. So that is quite game-changing and going to be quite a shaker for the industry, especially for the pharma and biotech sector, right? We had seen the market rout earlier on this year when Anthropic released tools for financial services, for legal services, and now they're coming for the healthcare sector. So we did see a sell-off in some of these biotech firms in the US session overnight and also in the Chinese session as well, though Anthropic did sort of reassure investors, saying that they will try to target the areas that are usually less attractive for traditional biotech players.
Bloomberg China correspondent Min Lo, thank you. Now, software giant Atlassian is downplaying concerns about AI's impact on the sector, saying demand for its tools remains strong and margins are expected to stay robust. CEO and co-founder Mike Cannon-Brookes spoke exclusively to Bloomberg about the company's growth outlook.
very biased position, but I completely disagree with the narrative. Our demand has never been higher at the moment. Having spent all week with customers here and in across Europe, they're incredibly bullish on our future, and they continue to consume far more of our applications as their teams and businesses get more complicated.
Okay, so the earnings story is there. You're seeing that demand, and yet I'm looking at the likes of Microsoft set for potentially its worst month in since about 2000. That stock is down about 20% this month. Your stock is down about 60% in the last 12 months. Is it the economic model and the pay for seat model? Is it a question mark for investors about whether or not you can sustain margins? It's been software as a service has been very rich on margins historically, but that's now being challenged. How can you convince, are the margins going to remain as robust as they have been historically?
I believe so. There's obviously a concern that the cost of delivering great AI applications, the intelligence underneath will continue to rise, so our cost of goods sold will get more complicated, margin will compress. We haven't seen that so far. We don't see that in our future. We've done a very good job of delivering amazing AI solutions to our customers. We have tens of millions of people that use our AI tools every single week, and we're still maintaining our margins where they are, and I believe it will only get better as you go forward, actually, as the...
margins will expand from here?
I think margins will continue to be strong. It's up to us to manage that, but we can certainly deploy a lot of great AI technologies. The cost of managing AI is changing every quarter, but I don't think that's an unmanageable problem.
Is the market just lacking nuance at the moment? It seems we've got this kind of big bucket of software companies, and we're just kind of leaving it as a big bucket, and we're treating everything in that bucket as the same. Is that... Do we go through a process at every kind of major pivot point? You kind of see this happening. The market finds it difficult to target winners and losers. How long do you think that phase lasts for?
Look, I couldn't tell you how long it's going to last for, but I think it's totally true. I think you see the entire sort of sector trading as one, despite there being, I would argue, pretty significant differences between different software companies in terms of how they are taking on AI. It's an amazingly powerful technology transformation that we're going through, and every software company is challenged to take this new intelligence, this new electricity, if you want to call it, and how they deploy it to their customers to help them solve the problems that presumably they were solving beforehand in new and innovative ways.
I thought that you had also, just like some other companies, been cutting jobs not that long ago. There is no connection with AI there, then, when you cut jobs?
Not in the way that people point out. We continue to try to adapt our skill mix, right? We are doing very well in the AI area in terms of our investments, and very well in enterprise sales as we grow continually in the enterprise. We're now north of 600 customers of over $1 million a year in revenue. And so we needed to adjust our skill mix to having more people in those areas, for sure. You could argue that's driven by the AI transformation. It's partly true, but it's not in the way that people sort of apply this very simple lack of nuance view of what AI is doing.
And that was Atlassian CEO and co-founder Mike Cannon-Brookes speaking exclusively to Bloomberg's The Open Trade. Let's do a check on Asian benchmarks as we kick off the third quarter of the year. Asia gaining momentum. We have the MSCI Asia Index, reversing earlier gains, currently down by 1/10%. Of course, it comes on the back of its best quarter in 17 years. Investors, of course, have looked past geopolitical tensions with fresh data reinforcing the view that the U.S. economy remains resilient, but today Asia is on the downside. In the FX market, the yen remains front and center. Traders on intervention watch, the yen breaching 162 per dollar at a 40-year low. Take a look where we are in terms of currency right now, 162.78. It's a level we're looking at. Still to come. Our next guest expects India's fiscal deficit to widen in 2027, while saying risks have eased. Nomura's chief Asia economist, Sonal Varma, will be joining us with her outlook. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. India's growth prospects have brightened following the de-escalation in the Middle East conflict. A monthly government report says the economic outlook has improved as lower oil prices reduced risks to inflation and the external balance. It also says foreign investors are buying Indian debt, and it's a matter of time before equity flows turn positive. And Bloomberg has learned that India's state oil refiners are planning to reduce their reliance on the Middle East following the supply shock of the Iran war. Instead, they're looking to rely more heavily heavily on alternative options, including spot market purchases. For more, Bloomberg government reporter Sudhi Ranjan Sen joins us from Delhi. Sudhi, what's India's plan to source energy in future? What alternatives are there?
Well, I mean, after spending, sleepless nights over the last few weeks, broadly what we are getting to hear is that there is now a decision, or at least a plan, that how to diversify the source of energy. Mind you, India imports about 90% of its energy and largely from the, earlier before the war, it was heavily dependent on the Gulf. So now there is a thinking as to how to widen out that basket and therefore reduce the uncertainty of a disruption in the Gulf or a war in the Gulf can cause. And if we look at the suppliers that India has reached out to during the time that the entire area was disrupted, there was uncertainty. It's gone from just over 20 to over 40. That's nearly doubled, and newer countries have been added to that basket. So that seems to be the thinking, is to diversify the risk, go across to more countries, and keep and source your energy to the extent possible. And the United States is emerging as one of the bigger and more reliable partners for energy for India.
Tell us more about India's efforts to cut its dependence on Middle East for oil imports. What does it all mean?
Well, I mean, this is a plan. This is a thinking that's going on, and to do that, first of all, India's historical dependence on the Gulf is there. They will, of course, India now says that they're going to buy oil, energy from anywhere in the market, which is cheap, which is going to help its citizens. So the main thing would be to look out at the West and the newer suppliers that are there, which India has already done. Then, of course, at the geopolitical level, manage the relationship, say, with the Saudi Arabia, with the UAE, which India is very close with. So it is not only at the supply level, it is also at how India will handle say refine. If it goes more in for the Venezuelan oil, it needs to look at the refineries and its capacity. So it's a kind of a shift that is being thought of, but may not happen immediately. We may not see that being implemented immediately. It will be a slow and a gradual process. That's what we are getting to here.
Sudhi, thank you. Bloomberg government reporter Sudhi Ranjan Sen. Let's get more from Sonal Varma, Nomura's chief economist for India and Asia, ex-Japan. Sonal, good to have you with us. Now that the energy pressure has eased, I mean, how much of that risk to growth, has reversed for India?
Well, purely looking from the energy side, the downside risk to growth from energy shock has reversed. But I think if we look at the other moving factors, I think the bigger downside risk that is emerging now is really the below normal rains and high likelihood that food production this year is likely to see some contraction in the output growth. So I think to some extent the upside from lower oil prices, the upside risk to growth from lower oil prices will get offset from the downside risks that are emerging from weaker monsoon. So on net, we are still comfortable with our growth projection of 6.6% in FY27.
What other high-frequency indicators are you looking at closely?
Well, we're looking at both the demand and supply side high-frequency indicators. So on the supply side, some of the infrastructure sector activity output growth did see some deterioration because of the Iran conflict. So production of things like fertilizer, which had dropped. With the normalization that is gradually expected going forward on the supply chain, I think some of this supply-related disruption on industrial activity should wane. So that is a positive. On the demand side, we're looking at both domestic and external indicators. So indications, at least so far on the consumer demand side. So passenger vehicle demand, two-wheeler, tractor demand, that remains quite resilient even in the month of June. And this is despite the increase in prices that a lot of the consumer companies had announced. And on the export front as well, things are holding up. So on the whole, I would say growth has held up relatively better than what one had anticipated. With the energy shock reversing, I think some of the margin pressure that companies are facing, the hit to fiscal finances for the government should ease at the margin. Where things will start to potentially worsen going forward is the outlook on rural consumption because of the weak monsoon outlook.
Sonal, what does it then mean for inflation? How soon do you think inflation will normalize?
Well, inflation in India has actually been slow to pick up, and I would say much slower than what many had anticipated. So despite the energy shock, the last inflation print on headline is at 3.9, which is still below the RBI's target. And a big part for this is the government's active control of energy prices locally. So we did not see the full pass-through. As oil prices come down, the oil marketing companies will see some improvement in terms of their margin. But at the consumer level, particularly on petrol and diesel, we don't anticipate a big reduction in prices. Maybe as we're starting to see things like LPG, there might be some reduction. But as I mentioned, I think the big theme to really watch for India is how the monsoon progresses and its impact on food inflation. And there we are coming on the back of very low food inflation in the last 12 months. And we do think that as oil prices cool down, it's going to be food inflation pressures that start to actually increase. So the trajectory for inflation in India is still headed higher. We are expecting inflation to average closer to 5% in FY27, despite the reduction in oil prices. So no big change on the inflation front, but a shift in the composition of what drives inflation going forward.
Let's pick up on the monsoon shortage. I'm just wondering, what is the worst case scenario? What's the worst impact it might have on the Indian economy, according to your calculations?
Well, the monsoon season has just started. It runs June to September. Rains in June were 40% below normal. And this is just with a weak El Nino. El Nino conditions are expected to become stronger in July and August. So there is a risk that the overall rainfall during this monsoon season could be worse than what the meteorological department has projected, which is 10% rainfall deficiency. The direct spillover of that will be on food production, particularly on crops like rice, pulses, oil seeds, and if there's less rainfall, then there's less water reservoir that'll be as we head into the winter cropping season, which could also be a potential risk for wheat production. So the direct impact is lower food production. The impact on food inflation will also be there. I think the good news, of course, is that India has rice buffer stocks that are 3 times what is needed. But on categories like pulses, we do think there's a risk that inflation is going to pick up. I think the third impact to closely monitor is what all of this means for rural demand in general. And rural actually has been outperforming urban consumption demand in the last 12 months. As we go forward, if we do indeed see weak rains continue in the next 2-3 months, and mind you, July, August are the most critical months for food production. This is where a majority of the sowing happens during the summer cropping season. Then we could see some adverse impact on rural consumption in the latter part of this year. So, yeah, quite a few important macro implications from the monsoon season.
And you got to wonder, Sonal, what it all means for the RBI and monetary policy. Do you see the RBI standing pat, staying cautious?
We do think RBI is going to stand pat. I think the biggest positive, of course, is that oil prices have come down. So the build-up on cost pressures because of higher commodity prices is reversing. Food inflation is likely to pick up. That can have some impact on expectations. But I think there are two critical differences. One is core inflation is extremely low. Excluding precious metals, core inflation is still running in the 2.5% range. And second, unlike some of the past years, let's say in 2009 when India also had weak monsoons, at that time rural wages were growing in double-digit, minimum support prices were rising at a very fast pace. So what started off as a pure supply shock on rains actually manifested into also stronger second-round effects. That's not at all the case this time around. So that means that the spillover onto core inflation and the broader second-round effects should be a lot more muted. So for the Reserve Bank, yes, some caution because of higher food inflation. But if there are adverse effects on rural consumption and core is contained and oil prices are lower, plus RBI and the government have announced measures to actually boost the balance of payment surplus through the various schemes that have been announced in the last 30 days, it, I think, reinforces the case for the RBI to stand pat.
And Sonal, is the worst over for the Indian rupee? It is still down 5% versus the USD year to date, among the worst performers in Asia.
Things do look quite positive in the next 3-4 months. One, of course, with oil prices coming down, we think India's current account balance will improve. Every 10% drop in oil price improves the current account balance by 0.4% of GDP. So this is a material improvement in the current account incrementally going forward. And second, our estimate is that the FCNRB scheme, or the diaspora bonds scheme that has been announced, banks have been allowed to offer leverage. So on the back of that, we think India can raise $55 billion just from the FCNRB scheme. And the other measures in terms of allowing banks and other state-owned companies to raise more dollar issuances will also lead to more inflows. So we think the balance of payment, which was running a deficit of close to $70 billion earlier in March, is now tracking a surplus of $45 billion. So that's a big swing in the balance of payment from a deficit to a surplus. So things do incrementally look more positive.
Some, like those in HSBC, expect an explosive dollar, which could be the pain trade for the rest of the year. What are the implications for the Indian rupee? What are the risks for the Indian rupee?
I think at least in the next 3-4 months, the inflows from the FCNRB will provide some offset for India. So, of course, if we do see a stronger dollar, that is a broader headwind for the EM complex. But in an environment where oil prices are down and a majority of this FCNRB inflows will come in the months of August and September, this can actually lead to some relative outperformance for India. I think beyond that, the reality is that we live in a very volatile global world. India does have substantial amount of FX reserves to deal with any kind of global volatility. But we do think the BOP swing in the next 3-4 months is going to be a bigger driver for India on a relative basis.
Sonal, thank you. Sonal Varma, Chief Economist, India and Asia ex-Japan at Nomura. We're counting down to the India Open. I think it's about a minute to that Open. Here's a look at Indian markets just ahead. Stocks coming online as proprietary trading firms and brokers brace for a major overhaul of how they finance trading activities. Starting today, the Reserve Bank of India will require bank guarantees issued to firms trading in capital markets to be fully backed by collateral with at least half in cash. It's the latest step to cool a derivatives boom that turned India into a global options hub. For more, let's bring in our India equities reporter Alex Gabriel-Simon. Alex, tell us more about the new measures and the impact on prop traders.
So, Haslinda, there have been multiple measures RBI has brought in, but the one that has been the most striking is that of bank guarantees. The new norms are requiring any trading firm that need bank guarantees to have them fully collateralized. A trader that I talked to called it a body blow to the entire domestic prop industry. And that's exactly what it is. Earlier, if you had, say, 5 million in capital, you could bring that to a bank, which then issues a promissory note to cover an obligation of up to 10 million, so double in case of a default. But prop firms use that to gain margin, which would effectively, after haircuts, be up to 1.7 times of the capital that they had. But now the same method would just give you 80% of the capital in margin. So this could have a bearing on liquidity in the options market as well.
You got to wonder why. Why is the RBI going ahead with this? What's the context behind the move? And when you take a look at the systemic risk, I mean, how much of the systemic risk is removed with this move?
Well, this has been going on for a year now because it first started with SEBI that came in with multiple measures that reined in on the options market. Then there was the government that came out with tax hikes, both in securities transactions tax as well as capital gains tax. So essentially what happened is with the allegations from SEBI that Jane Street has manipulated the really big options market in India to gain at the cost of retail investors, all the regulators and authorities are worried, right? And they're trying to crack down on this market, try to curb the amount of losses that retail investors have been making in the market. Do we know for sure that these measures are enough, that this is done enough to reduce those losses? We don't know for sure. And people that I talk to, they're not even convinced that this is the last measure that might be coming in.
And Alex, how does this affect foreign HFT firms that have been trading in India? And, you know, I'm wondering whether you'll see flows moving elsewhere.
So it won't really affect the foreign HFTs, right? All of these firms have been expanding in India. If you look at IMC, Optiva, these firms have been growing their ground presence in the country and they've been trading more as well. What happens here is there is a dichotomy in how this norms will be working. Because for domestic firms, especially the smaller ones, they've been really trying to get these bank guarantees, and that was the amount, that was the funding that they mostly had. But foreign firms have other avenues. They can use the gift city route, which avoids taxes to a certain extent, and they can also get a promissory note from their parent firm that's like a standing credit line that would also give them extra margins. These are not accessible to the smaller prop shops. If at least you're a bigger firm, you can tap the corporate bond market, for example. So there is a disproportionate impact of this rule in that sense.
Bloomberg's India equities reporter Alex Gabriel-Simon, thank you. Now, still to come, basketball superstar Yao Ming tells us how the sport can build bridges between China and the U.S. and why the NBA Hall of Famer thinks another league is the sport's most successful brand. Keep it here with us. This is Bloomberg. Well, the eyes of the sporting world may be on the FIFA World Cup right now, but Chinese basketball star Yao Ming says his sport is still the most popular internationally. The NBA Hall of Famer spoke to us about the global reach of the top U.S. leagues and how the sport connects America and China.
Basketball is the most popular sports in the world. I know this, FIFA's World Cup now is probably top is headline for all the newspaper today. But I have to say that basketball is shoulder to shoulder in China compared to football or soccer, what we call, and that influences so many of the young generation that they play on a basketball field every day after school. Sometimes they skip school for that. After me, there's many young fellows who join the NBA. Last year we have a young player called Hansen Yang, who joined the Portland Trailblazers. I'm sure there's many young players like him that eager to reach their sky, hopefully here in the next few years. So basketball really connecting us together on the same field, and that's the magic of it.
Well, one of the places that the NBA is trying to expand is in Europe specifically, trying to build a league there. Are you in any talks? Do you have any interest in potentially being part of the ownership process?
That's a big news, obviously. Yeah. It's a very big news, and I have a few European friends. We're talking to each other once in a while to see how that's going. So, I wish all the success. I'm sure NBA have their rich experience to help this being a success, and I'm sure they will bring this sport to another level.
I am curious about the cultural impact. When we talk about the NBA's impact on China, and obviously the exporting of our brands, whether it's Nike and some of the other brands out there, Reebok, which you were a part of as well. We're also kind of, to a certain extent, seeing the reverse of that. We're seeing U.S. players now getting endorsement deals with Chinese firms, and I am curious as to what you see over there with regards to how younger consumers, the types of brands they're looking for, the types of products they're looking for.
It's very nice interaction. Stephen Curry just signed with the Li Ning brand, which is a huge impact. Everybody excited about it. And the Li Ning brand, his founder, Mr. Li Ning, is a national hero for us. When I was young, he won an Olympic title back to 1984 in Los Angeles. He's a national hero for us. And now imagine, those, there's a hero from the older generation to the current generation that's really make a lot of. I'm sure that will be a very successful cooperation, and I'm really thinking that will be not only one, there will be more coming.
Well, I'd love to talk a little bit more about your investments, because one of them is the Asian University Basketball League. Nets owner Joe Tsai also is invested there. Talk to us a little bit about what your thought process was behind that investment and what you're hoping that that can achieve.
I'm always excited about NCAA. The NCAA, besides NBA, NCAA is the most successful basketball brand in America. That for sure. And in China, that we have our college basketball league too. But also Asia, especially Asia is a big market, and there's many famous college basketball teams that are out there. And I spoke to Joe that we agree that they need a platform that can put everybody together, and we're sure that in that area we somehow, hopefully in the future, after a couple of years, that we can create similar things like NCAA.
Yao Ming, sometimes referred to as the Great Wall. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.